So hello everyone, and thank you very much for joining us today for our Financial Reporting in the Natural Resources Sector webinar. I'm Joseph Archer, and I'm a partner and head of natural resources here at PKF Littlejohn. Before I just intro the speakers, I just want to make sure a few housekeeping points are covered off. Firstly, if you have any questions at all during the webinar, you can submit them through the Q&A widget at the bottom of the screen. We'll try to answer as many as possible of these at the end of the webinar, but if your question needs a fuller answer, we simply run out of time, we will get back to you, but please do note we do capture all questions and they are passed on to the panelists. Secondly, an on-demand version of the webinar will be made available shortly, and we'll also circulate the recording via email so you do all have it to hand. The aim of this webinar is very much to help ensure that finance teams in the resource sector are up to date on the 24/25 year-end reporting matters, so you can consider their potential impact on your financial statements and assist you in preparing your annual reports. And hopefully you've got sufficient time to do this and also ask any questions that you may have on any of those points that we are raising. Our speakers will be discussing regulatory updates, including revisions to ISA 600, the UK listing rule changes, and also the new requirements for European listings, environmental disclosures, including TCFD reporting requirements and examples of best practice, and IFRS 9 and common pitfalls, which we do see quite a lot when we are auditing. Now on to our speakers. Thomas Sheehan is an audit director who's been with PKF for 9 years. He manages a portfolio which consists of mainly listed companies and groups, a number of which to undertake mineral exploration and production. Elorm is a senior manager in the business service team with 11 years of relevant experience. She's very skilled in managing statutory audits for large listed clients across UK markets, and she works extensively with natural resource companies, mainly in mining and oil and gas explorers and producers. And she's worked pretty much across the globe and also works very closely with PKF International Network firms as well. Lakshmi is also a director in our business service team and manages a portfolio of large, complicated listed groups across various sectors, but with a heavy leaning towards natural resources. She's got a huge experience of auditing groups and has such groups operating again across the world, just like Tom and Elorm. She's also contributed to preparing our natural resources accounting guide, which is also available on their website. So do always feel free to reach out and take a look at that if you've got any questions or concerns when you're doing your work. Please remember to submit your questions to our panelists, and I'll now hand over to Thomas to begin the webinar.
Great, thanks, Joseph. Hi, everyone. I'm Tom, an audit director at PKF. I'll be discussing some of the key regulatory updates that have taken place recently and how they may impact you and your upcoming audit. Great, so starting off with the ISA 600 revisions. So as an introduction, ISA 600 covers essentially group audits and what we are required as auditors to cover. It also covers the use of component auditors. So this may be where perhaps you have a subsidiary based abroad and we use a local component auditor to conduct work on our behalf. The updates in the revisions are effective for periods commencing on or after the 15th December 2023, so will really first apply to December 2024 year ends. The main objective of these revisions was to improve audit quality and communication. There are a number of changes which will impact group audits, which I will now discuss some of the key ones. So firstly, enhanced focus on risk. So one of the key revisions or aims of revisions is really to ensure that the auditors at group level have a greater emphasis on a risk-based approach, essentially to align more with the ISA 315, which was revised in the past couple of years. The group engagement team are now more directly responsible for identifying and assessing the risk of material misstatement for all components in the group, and really making sure they drive the designing audit procedures. So as well as that, there's greater responsibility and supervision required by the group audit engagement team. So we're now explicitly responsible for directing, supervising, and reviewing the work of component auditors and really applying more rigorous challenge. We're also required to make sure that component auditors understand the strategy of the group audit and their role within it. In addition, there's also communication between auditors and quality management, which is a focus here. So the revisions enhance the requirement for more robust communication between us as group auditors and component auditors throughout the audit from start to finish. And this has really been to make sure it aligns more closely with ISQM1, emphasizing the need for proactive management throughout the whole audit from the group engagement team. Some of the other key changes include there being a higher level of professional skepticism being required when we as group auditors are reviewing and assessing the work of component auditors. There's also been a change in the definition of components. So as well as traditional subsidiaries, this now could include divisions, branches, shared service centres, and non-controlled entities. And lastly, there's also been a removal of the classification significant components. So this will be where, rather than classifying components, we're now required really to focus on viewing risk level at the assertion level for each component across the financial statements. So what are the impact of some of these key changes? So firstly, there's going to need to be enhanced and earlier communication between us as group auditors and management at the planning stage. Now, this includes both group management and also the component management. In order to be able to drive the risk assessment process at the component level, we as group auditors really need to understand the processes and systems of the components as well as the group as a whole. As well as at the planning stage, there's going to need to be enhanced communication throughout the whole of the audit between the group auditors, management, and component auditors, so more regular touch points. And this includes particularly when throughout the audit, there are areas of significant judgment and estimation at the component level. We as group auditors have to be more engaged in that process and more involved in those conversations. The potential change, there will also be potential changes in the scope of work required at the component level. So these changes in the definition and the classification means that there could be some components that are now brought into scope that weren't, some may fall out of scope, and also the level and nature of the work that would be required to perform, or that the component auditors would be required to perform, could change. So now moving on to the second set of regulatory updates, the changes in the UK listing rules. So just to recap, the UK listing rules apply to companies listed on any UK stock exchange. That covers the LSE, AIM, and Aquis. The significant changes made to listing rules were effective from very recently, from the 29th of July 2024. And the primary objectives of these changes was to simplify the listing process, making it more flexible for companies to list, with the overall aim to really make the UK a more attractive market to list on and boosting economic growth while still protecting the investors. And the FCA have been really clear that these rules allow for greater risk, but this is essentially representing a change in the UK's risk appetite. So what are some of the key changes? Well, first of all, those companies that were previously in the main market and premium listing categories, that's now been replaced with the equity shares in commercial companies, the ESCC. But companies who were previously listed on the main market and premium listed will have been automatically transferred to the transition segment, and they can then elect to join the ESCC. Now, the transition segment allows these companies to essentially continue to follow the rules that were previously in place before the revisions, but following an election to join the ESCC, all new rules will now apply. So going forward, companies who list cannot join this transition segment. And it should be noted that there's been no set date, but the FCA could look to remove the segment at any point in the future. So one of the key changes is the streamline and eligibility criteria. There's been a number of changes to the listing requirements, which essentially make the listing process more flexible. Some of these include the dual class share structures, so companies now have more flexibility to be able to adopt the DCSS. In terms of revenue track record, whereas before companies were required to disclose 3 years worth of revenue, that's been removed. Some companies may only need to provide 2 years unaudited financials, but this does depend on the requirements of their prospectus. In addition, some companies are no longer required to provide clean working capital statements as part of the listing, and the changes in the free float requirements have drastically reduced the minimum percentage of shares which must be held by public investors to 10%. So carrying on, so in terms of the acquisitions, where a company is making an acquisition, gone is the requirement to publish 3 years worth of historical information. The minimum is now 2 years of unaudited historical information in respect of the target. However, if the target was previously audited, there are 2 years worth of audited financials which do need to be included in that prospectus. In terms of disposals, where a company is disposing of another company, but it doesn't have the required information available to publish, a statement has to be put out by the board, which is explaining the fact that information is not available or it can't be produced. It also needs to explain how the value of the consideration for the disposal was arrived at and confirm that they believe that consideration to be fair. So some of the other changes, so in terms of corporate governance, all companies on the ESCC are required to comply with the UK Corporate Governance Code or explain why they haven't complied. Previously, that only applied to premium listed companies, but please note this is not applicable to those on the transitional segment. For related party transactions, there's no requirement for shareholder approval, but companies would need to have both board and sponsor approval, whilst also making sure they announce those transactions exceeding the 5% threshold. For shell and special purpose acquisition vehicles, there is a new listing in capturing those particular companies, and they will now have 24 months to be able to complete the transaction post-listing, but that can be extended by up to an additional 3 years with shareholder approval. So in summary, the key changes clearly have a significant impact both on those looking to list in the UK and those currently listed. I think you'll be aware that the boards will need to ensure that they obtain a full understanding of the new categories and the corresponding rules, and making sure they take measures to ensure they comply with those rules, but also they'll welcome the changes and enhance flexibility that these changes bring. Great, so lastly, moving on to the new requirements for European listings. So the European Commission introduced the Listing Act, which proposed a number of key changes from previous legislation. The primary objective of these changes was to make all EU public capital markets, which includes the LSE, AIM, and Aquis, more attractive and accessible, especially for SMEs. So the provisional agreement was made on the 1st of February 2024, and actually only 9 days ago they adopted the listing, and the rules are effective 20 days after adoption, so the rules will come into force on the 28th of October. So what are some of the key changes? So essentially, the first one is simplified prospectus requirements. So there's a number of changes that have been made to make it easier for companies to list and to issue prospectuses. So firstly, if a company has been listed for more than 18 months, a simplified prospectus can be issued where they're looking to make secondary issuances. And this essentially just reduces the disclosure requirements. The threshold for a prospectus being required has also increased significantly from 20% to 30% of the number of securities already admitted to trading. And there's also going to be new types of prospectuses introduced to accommodate different sizes of companies and different types of issuances. There'll be a change in the multiple vote share structures, enabling companies more flexibility in their governance models. With regards to market abuse regulation adjustments, there are some slight changes. So there's now delayed disclosure enabled for inside information for immediate steps in a protracted process. And the conditions for delaying disclosure to the market have been simplified. Rather than a general condition for delay, there's now 3 specific conditions that need to be met. For SME growth markets, these changes essentially will be able to facilitate their access to capital markets and reduce the regulatory burdens. So they'll be taking measures to enhance liquidity by encouraging more trading activity. They'll be improving potential investors' access to information about SMEs and simplifying and standardizing the admission requirements for SMEs, making it easier for them to list on particular growth markets. So to summarize, again, these changes will have a significant impact on both those looking to list on an EU market and those currently listed. They're likely to be gratefully received by both boards and investors alike, given the flexibility they provide. But again, as with all regulatory updates, boards will need to ensure they obtain a full understanding of these changes and take appropriate measures to ensure they comply. Great, I'll now hand you over to Elon.
Thanks, Tom. Morning, everyone. My name is Elon, and I'll be discussing the importance of environmental disclosures, TCFD reporting requirements, and best practices for effective reporting. As global awareness of climate change and environmental degradation grows year on year, natural resource companies continue to face increasing pressure to disclose their environmental impact. So environmental disclosures have become a crucial tool for companies, investors, and regulators to evaluate the environmental impact of their operations. Effective environmental disclosures therefore help companies comply with regulatory requirements, provides for increased transparency, and builds trust with all their stakeholders. What are then environmental disclosures? These are publicly shared information about a company's environmental policies, practices, and performance. And there's a key focus on climate-related risks and opportunities. These disclosures enable stakeholders to be able to assess how a company addresses its environmental challenges, such as greenhouse gas emissions, waste management, water usage, and energy efficiency. So the aim of these disclosures are to improve transparency, reduce information asymmetry, and help stakeholders make informed decisions about their impact on the business. And one of the most effective frameworks which guide environmental disclosures is the Task Force on Climate-Related Financial Disclosures, the TCFD. This framework was established in 2015 by the Financial Stability Board, and it's a set of recommendations for voluntary and consistent financial risk disclosures across all industries. There's also mandatory reporting in place that has been built on this framework to ensure that certain listed companies are disclosing the right information about their environmental impacts. These disclosures are also on a comply on explain basis, such that companies are not compulsorily required to disclose, but they need to explain in detail as to how come they are unable to disclose these information. So going on to the TCFD framework is built around 4 key pillars. The first one being governance, where companies are required to disclose the governance structure in relation to their climate-related risk and opportunities. Companies are required to describe how the board has oversight over these disclosures and management's role in ensuring that the right disclosures are in place in their annual reports. Around strategy, companies need to assess and disclose the potential impacts of these risks and opportunities on their business strategy and financial planning. Also on risk management, organizations need to outline their process for identifying, evaluating, and managing these climate-related risks. And these need to also be integrated into the overall risk management framework. On to the final pillar, which is metrics and targets. Companies are encouraged to disclose the metrics used to assess climate-related risk and opportunities. These would include greenhouse gas emissions, and companies also need to establish the targets for reducing these emissions over time. Why are environmental disclosures so important? The first one being regulatory compliance. As we all are aware, natural resource companies are subject to a number of environmental regulations, and governments are implementing stricter regulations to ensure that companies disclose these environmental practices and impacts. So compliance with these regulations are crucial to avoid any legal repercussions and maintain operational licenses. Investor expectations are also another importance. Transparent environmental disclosures provide investors with critical information that allows them to evaluate these risks and opportunities, making companies more attractive for investment. Doing this also signals a commitment to sustainability and helps companies attract socially conscious investors. Comprehensive environmental disclosures also demonstrate accountability to all stakeholders, and it signals a commitment to responsible resource management, fostering better relationships and enhancing corporate reputation for the companies. This slide also covers the key areas of focus in an environmental disclosures. The first one being emissions and climate impact. Natural resource companies must disclose their greenhouse gas emissions across their operations, and companies need to provide detailed information on their carbon footprints, target for emission reductions, and strategies to achieve these goals. Water is very critical for many natural resource industries, including mining, oil and gas, and agriculture. And companies should disclose their water usage, sources, management practices, including efforts to minimize water consumption and prevent any contamination. On biodiversity, natural resource extraction can significantly impact biodiversity and ecosystems. So companies need to evaluate and disclose their effects on local wildlife, habitats, and communities. Waste management is also really critical. Therefore, disclosures must cover waste management practices, including the types of waste generated, recycling efforts, and plans for waste reduction. Not all companies listed on the London Stock Exchange main market are mandated to apply the TCFD recommendations and produce any TCFD-aligned disclosures in the annual report. The requirements that apply depend on the category of listing under the UK listing rules. So per the UK listing rules, the LSE companies shown on this slide must provide the TCFD-aligned disclosures in the annual report. For any avoidance of doubt, investment entities and shell companies are exempt from complying with this requirement. This table shows a checklist that can serve as a guide for account preparers when they are preparing their environmental disclosures. So account preparers must always make sure all these 4 requirements have been satisfied. A few of them being whether or not the company has included TCFD-aligned disclosures consistent with the framework in their annual financial report. Also, where information has been disclosed in a document other than the annual report, these 3 items where the recommendations or whichever disclosures have been disclosed in that document, a description of the document and its reference, and an explanation of why those recommendations have been disclosed in another document other than the annual financial report. So certain UK incorporated companies are also required to provide some environmental disclosures in line with the TCFD framework. So this table outlines the requirements applicable to companies that meet specific criteria. These requirements are applicable to UK public entities that have more than 500 employees, UK AIM companies that have more than 500 employees, and other UK companies with 500 employees and over 500 million turnover. So although it's not technically on a comply or explain basis, the requirements allow companies to apply judgments as to whether the elements are appropriate in their circumstances. So to name a few of the reporting requirements, companies are required to describe their governance structure and how that relates to evaluating the impact on the environment. Also, companies need to explain the processes they go through in identifying, assessing, and managing these climate-related risks and opportunities. Also, the time period within which they are assessing these risks and opportunities and the impact on the company strategy must be disclosed as well. This slide shows a decision tree of how a company can decide or determine whether they need to provide any disclosures. And it illustrates whether a UK company falls in the scope of the Companies Act of 2006. So for example, a parent company that's included within UK group financial statements where they have complied with the regulations, disclosures are not required once the answer is yes. On the other hand, if the UK group financial statements haven't complied with the regulations and they have more than 500 employees, they need to disclose if they meet this criteria. Also, if the company is a traded company, banking or insurance company, and also have 500 million pounds in turnover, disclosures are required as well. The TCFD disclosure requirements under the UK listing rules are consistent with the Companies Act 2006 regulations to a large extent. This table sets out the key similarities and differences. And to go through just a few of them, the main differences are that the Companies Act 2006 requires all companies that fall within the scope to mandatorily disclose these information. And the UK listing rules, however, is applied on a comply or explain basis. So you can decide based on judgment and based on the materiality assessment, companies can decide to provide the required disclosure or explain in detail as to how or why the company is unable to provide the relevant information. In terms of the location of disclosures, the Companies Act 2006 requires that it should be within the strategic report of the company's annual financial report. But the UK listing rules are not prescriptive in this regard. They can be recorded in a different document other than the annual report, but there should be sufficient information and a cross-reference as to where that information is. In terms of similarities, there's a general principle that companies must carry out a materiality assessment and make sure that any information where it's either omitted or misrepresented could impact information for decision makers or the users of the financial statement. So it's really important to assess the kind of information that's going in there and whether it's material to the accounts. Apart from the greenhouse gas emission disclosure requirements, the Companies Act and TCFD regulatory requirements are also highly consistent because it's all built around the 4 key pillars of the TCFD framework. Hence, most of the information required are mostly similar. Now we go on to the best practices for effective environmental disclosures. Most companies must ensure that they integrate the climate risk into the business's core strategy. So climate risk should not be treated as a separate entity from business strategy, but they should be aligned with a corporate strategy to ensure that climate change considerations are integrated into all facets of decision making. Companies must adopt a long-term perspective because climate change is a long-term challenge. Companies must also perform scenario analysis where different potential future climate scenarios are considered and they could understand how it affects a business and helps them prepare for a range of outcomes and increases resilience. Companies must also develop clear and quantifiable metrics to ensure that there's a set target which the company is able to focus on and measure progress against. Transparency is also really critical for credibility, and companies should be open about their climate-related challenges and limitations and trade-offs. Also, companies should engage their stakeholders, and this brings about accountability and improves relationships with them. The final best practice is to ensure that there's independent verification and assurance of climate-related disclosures and hope it enhances credibility and ensures accuracy as well. While there are many benefits of TCFD reporting, organizations often face a number of challenges. Data gathering is very complex and can be resource intensive. So companies must ensure there's enough resource in place to gather the relevant data. Also, companies must ensure that they align their TCFD recommendations with their existing risk management and reporting frameworks to ensure that any significant adjustments are made. Companies may also lack the necessary expertise to analyze these climate-related data and risk effectively. So this necessitates significant investment in training or ensuring that the appropriate external consultations are carried out. In terms of additional considerations, before we close on this session, companies are encouraged to align their disclosures with existing reporting standards, such as the Global Reporting Initiative or the Sustainability Accounting Standards Board. In terms of frequency, it's recommended that these disclosures are made on an annual basis, allowing stakeholders to track progress over time. In terms of integration as well, organizations should aim to integrate TCFD disclosures with their mainstream financial reports, and this enhances the relevance and accessibility of information to investors. In summary, environmental disclosures are very crucial for natural resource companies, and this helps them to navigate the complexities of sustainability and regulatory compliance. It helps them also build trust with their stakeholders and enhance their reputation and position them for long-term success in a rapidly changing landscape. Thank you, and I'll now hand over to Lakshmi.
Thank you, Elon, and good morning, everyone. I'm Lakshmi Upadhyay, Director at PKF Littlejohn, and I will be covering IFRS 9 financial instruments, focusing on three key areas: expected credit losses, convertible notes, and hedging arrangements. These topics are crucial for financial reporting in the natural resources industry, where market volatility, commodity prices, and credit risk play a central role. These are also the areas where we as auditors commonly observe deficiencies in the financial statement disclosures. There are three key aspects of IFRS 9. The first is classification and measurement, which is about determining how financial assets and liabilities should be categorized and valued. The next is expected credit losses, which is a forward-looking impairment model requiring companies to assess credit losses in advance rather than waiting for the default event to occur. IFRS 9's hedge accounting rules reflect how companies manage risk by allowing more flexibility and broader use of hedging strategies. It ensures that the financial reporting aligns with actual risk management activities of a company. We will cover expected credit losses and hedge accounting in more detail in the coming slides. Starting with expected credit losses, mining companies often have long-term contracts and sale agreements, which can be affected by changes in commodity prices, credit risk of the customer, or political and economic risks in the jurisdiction of the customer. It is also common in mining industry to see parent companies financing the exploration and mining activities of the subsidiaries in form of intercompany loans. Both these transactions come under the purview of IFRS 9, and it is important for companies to estimate credit losses on these receivable balances. The ECL model operates in three stages. Stage 1 is where there hasn't been a significant increase in credit risk since the asset was first recognized. In this stage, a 12-month ECL is recognized, which is an estimation of how much the company would lose if the customer defaults within the next 12 months. When a financial asset has experienced a significant increase in credit risk since initial recognition, the asset moves from stage 1 to stage 2. And in this stage, a lifetime ECL is recognized, which is an estimate of the total expected losses over the remaining life of the asset. Stage 3 is when the asset becomes credit impaired. And similar to stage 3, a lifetime ECL is recognized. However, the interest is adjusted to be calculated on the net value of the receivable, which is after adjusting the impairment. IFRS 9 does not prescribe a fixed model to assess the expected credit losses. However, there are three commonly used models. The first is a probability of default model. This estimates the chance that a customer will default and the expected loss if they do. This is used mostly for complex financial assets, and we don't commonly see this in the natural resources industry. Loss rate approach model is a more simpler method and is often used for short-term receivables. It looks at the past data on defaults and adjusts the estimates based on current and future risks, such as if the commodity prices fall, so it adjusts the impairment according to that. Simplified approach is the most commonly used model for trade and intercompany receivables, and in this model, companies can apply a lifetime ECL from the start. I would like to bring attention to some common challenges faced by mining companies when assessing the expected credit losses, specifically in transactions involving loans to subsidiaries. So parent companies often provide loans to subsidiaries for working capital to carry out exploration and mining activities. Management have to carefully assess whether these arrangements fall under the scope of IFRS 9 or under IAS 27 as a capital contribution. It is important to note that intercompany loans also need to be assessed for potential credit losses, just like any other trade receivable. However, these arrangements usually have unique terms and conditions attached to it, such as the repayment would start when the production starts, which means that there is no fixed repayment structure, or these could be interest-free, or these could be repayable on demand. So a careful assessment is required on these. Management also need to be mindful about any regulatory changes, such as an increased focus on climate risk, as this may impact the future demand and ability of the customers to pay, depending on which natural resources they are producing and which jurisdiction they are in. The next topic is convertible notes. Convertible notes are often used by mining companies to raise capital, as they offer a combination of debt financing and potential equity conversion. The debt component, or the host contract, represents the obligation to repay the note with an interest, while the conversion feature gives the investor the option to convert the debt into equity. This feature, the conversion feature, can be classified as either equity or a derivative liability, depending on whether or not it meets certain criteria under IFRS 9. To understand the classification, the first step is to understand whether the note has an obligation to deliver cash or another financial asset at the time of maturity. If it does, then it is classified as a financial liability. The next step is to understand whether the settlement is to be made by issuing equity shares, in which case it could either be equity or a derivative instrument. For a convertible note to classify as equity, the settlement has to be made in fixed number of equity shares. If the instrument fails this test, it is treated as a financial liability because the issuer does not have control over the number of shares that will be issued. When accounting for convertible notes, we have to separate the debt and the conversion feature. The debt component is measured just like any other loan, which means it will be recorded at present value of future cash flows and then amortized over time. The conversion option is to be measured based on the classification. So if it's equity, it is recorded as a residual value after subtracting the amount left after subtracting the debt component's value. If it is an embedded derivative, the derivative component has to be separated from the host instrument, and it is measured at fair value. Any changes in the fair value flow through the statement of profit or loss. To explain this in the form of an example, so this is a 3-year credit note, 3-year convertible note issued at an interest of 10%. And at maturity, there is an option to convert this into equity. Now, since there is an element of conversion to equity involved, this is an embedded derivative. To be able to correctly classify and measure this instrument according to IFRS 9, the first step is to separate the derivative and the host contract. The debt component is the principal value that has to be repaid, and this is classified as a financial liability. The conversion option is tied to the share price, and this is variable, which means that the conversion option does not meet the fixed criteria, and therefore it's not equity, and it is classified as a derivative liability. The derivative is measured at fair value, which in this case is determined to be 50, and the residual value of 950 is allocated to the debt or the financial liability. The transaction costs will be proportionately split between the two instruments. The next topic is hedge accounting. Hedging is a key risk management tool which allows companies to mitigate risks such as fluctuating commodity prices, interest rates, foreign exchange rates. The objective of IFRS 9 is to align hedge accounting with the principal risks and risk management policies of the company. There are three main types of hedges under IFRS 9, each designated to mitigate a different kind of risk. The first is a fair value hedge, which is used to protect the company against changes in fair value of assets or liabilities as a result of changes in commodity prices or interest rates. Both the hedged item and the hedging instrument in this case are measured at fair value through P&L. Next is a cash flow hedge, which is used to protect against volatility in cash flows due to changes in prices or exchange rate. The effective portion of this hedge is recognized as fair value through OCI, and when the transaction is complete, these are reclassified back to the statement of profit or loss. Net investment hedge is used to manage foreign currency risk when a company has investment in foreign subsidiaries. A parent company can use this hedge to protect against fluctuations in the currency of its subsidiary. And similar to cash flow hedge, the effective portion is recognized in OCI and accumulated as a translation reserve until the investment is sold or liquidated. IFRS 9 has made hedge accounting more flexible. However, it requires companies to follow a strict documentation and testing. At the outset, there is a need for clear documentation defining the hedged item, the hedging instrument, the risk being hedged, and how effectiveness will be measured. So the hedge is expected to be effective, which means the changes in the hedging instrument must closely offset the changes in the value of the hedged item. This needs to be monitored regularly to ensure the hedge remains effective. If any of these criteria fail, the hedge will not qualify to be accounted under IFRS 9. Hedge effectiveness involves assessment of economic relationship between the hedged item and the hedged instrument, the dominance of credit risk over the hedged risk, and calculation of a hedge ratio. Hedge effectiveness has to be regularly monitored, and the most common methods to monitor these are dollar offset method and a regression analysis method. Hedge accounting has to be discontinued if the hedge no longer remains effective, or if the risk management strategy of the company changes. In this example, there's a copper mining company that has a large inventory of copper, and it's worried that the copper prices might drop over the next few months. So to protect itself, the company enters into a future contract to lock in the price of copper for future sales. So in this case, the copper inventory is the hedged item, and the future sales contract are the hedging instrument. By regularly testing hedge effectiveness, the company ensures that any drop in the value of copper inventory is offset by the gains in the future contract. This explains how the company has protected itself from decline in copper commodity prices, and also a regular hedge effectiveness testing appropriately offsets the risk. I would like to highlight that IFRS 9 also allows for rebalancing, which is used when the hedge ratio becomes effective. ineffective. So like in this case, when the company expects the demand to decline, it's able to adjust the hedging instrument, which is the future contract, to rebalance the hedge effectiveness. Otherwise, they would have to discontinue hedge accounting. So I will recommend, so we will be releasing few articles on these topics, which will give more insights and practical examples. And these will be coming over the next couple of weeks. And thank you. I will now hand back to Joseph to see if we've received any questions.
Okay. I think we do have some questions that have come through. If we probably start off with quite a general one, just in relation to the circulation of the natural resources guide, we can certainly do that. I know who's asked those questions, so we'll send that on to you accordingly. The next question that's come through on the chat, it will be for Elon on the TCFD disclosures, and it is a question saying, will they be required only in an annual report or also at half year or in a prospectus at IPO?
Right. So currently it's recommended to be done in the annual reports, but definitely if you're able to do it during the half year reporting or on IPO, that would be very helpful and provide additional information to the users of the financial information. So it's recommended only the annual report, but there's nothing stopping you from doing that in your half year reports or IPO reports as well.
I think we have one as well for Tom, and as having had lots of difficult conversations with people, with clients on fees when ISA 315 came in, I can understand this one. So obviously Tom was talking about ISA 600 and the increasing work scope that's got to be done surrounding component auditors. And so the question is, audit fees went up as a result of ISA 315. Will therefore the introduction of the new ISA 600 impact audit fees? Sorry.
Thanks, Joseph. Great question. So I think it really does depend on the composition of the group, the level of activities in each component, and for how many component auditors are being used. I think, of course, there's no getting away from the fact there will be additional time costs from our perspective due to the requirement for enhanced risk assessment at the component level, more communication throughout the audit, us having to apply more challenge, and also an enhancing of the documentation required for our review of the component auditor's work. I think this though can be kind of reduced and mitigated in part by, I think, just clients facilitating earlier interactions with the group auditors and ensuring we've got the access to the group and component management team, making sure we're getting that information that helps us drive our risk assessment process and design an efficient audit. So of course there will be additional costs, but yeah, those are the main ways in which I think those can be mitigated and reduced.
That's great, thank you, Tom. Just a couple more we've got through. One is, how does a listed company determine, I think this is for Elon, sorry, but how does a listed company determine whether climate-related financial disclosures are consistent with the TCFD recommendations and recommended disclosures in terms of materiality assessment?
Okay, so a company is required to carry out its own assessment to ascertain the sufficient level of detail to include in their financial reports. But you need to take into account the nature, size, and complexity of your business, and definitely also take into account the level of exposure to these risks and opportunities and the scope and objectives of the climate-related strategy as well.
Thank you very much. And another one for you, Elon, is who is responsible for the TCFD disclosures in the annual report?
So it's management's responsibility, and directors have the ultimate responsibility for ensuring that they thoroughly review and understand the requirements of the UK listing rules, as well as the TCFD recommendations. So it's definitely the responsibility of management, and auditors need to also challenge management on their disclosures as to whether the right amount of information is available in there.
Yeah, I think probably just following on from that as well, I think the long-term goal is probably that auditors will be required to sign off something in relation to that. Where that will end up, I don't know. There is something like that being introduced from an EU perspective, this kind of falling into place from December 24. So the general feeling is that there will be some requirement for auditors to sign off on something in the future from a UK perspective. When that is, I don't know, but it's just probably useful to have that thought in the back of your heads that at some stage that will be required going forward. And then I think the final question that we've had through, which looks like it's very much for Tom, is who will benefit most from the new streamlined eligibility criteria?
Thanks, Joseph. I think in short, startups and other companies with limited revenue track records, I think they're the ones who benefit the most from the fact that the rules are being removed, which require 3 years worth of revenue. So companies looking to list now would only need to perhaps provide only 2 years worth of unaudited financial statements. Though again, this does depend on the exact requirements of their prospectus. I think it'll also not just be those companies looking to list, but also those actually looking to do further raises, and the fact that the requirements or the thresholds in order to issue a prospectus have been raised. So yeah, I think a lot of people, a lot of companies will benefit.
Great. Well, that's all the questions we've had through. But obviously, please do bear in mind that if you do have any further questions, don't ever hesitate to either reach out to either myself or any of the panelists here, or equally any of your contacts at PKF. Thank you very much all for attending, and also thank you very much to all of our panelists today for their presentations. And I do hope you found them very useful. So thank you very much indeed, and I look forward to obviously seeing hopefully most of you in the near future. All the very best. Thank you.